Hello, this is Professor Randy Menton, and today I'd like to walk you through, in your book, Exercise 6.7, FIFO and LIFO costs under Perpetual Inventory Systems. And so let me begin just by explaining what is in front of you here. I've gone ahead and I've put in some titles that I know have to be there. I have left purposely all of the mathematics for calculation as we go through them, and I'm going to also show you some of the complexity of actually making these calculations, and as we go through. Now, FIFO, as you are aware, it means first in, first out. So what we would do if we sold goods is we would begin with whatever was in our beginning inventory, and once that was exhausted, we would go to the first purchase and take whatever we need out of that purchase. Once that was exhausted, we would go to the second purchase and the third purchase, and so on. But what you would see then is that we were always looking at what was left from the previous purchase before we go to the new purchase. So the first ones in would be the first ones out of our inventory under this particular cost schema. Under LIFO, last in, first out, we're doing just the opposite. We're looking at the first purchase and taking whatever our sales out of the first purchase and then going back into the beginning inventory to get whatever we need from there. Now, what your authors did in this case was they gave us an identical beginning inventory, and that's reflected in what you see here. Clearly, that would not normally be the case, because as we go through these two methods, you'll see that they result in different extended costs, different inventory costs. The units never change because the units are the units. We buy some, we sell some. Those don't change, but the cost per unit will change based upon the inventory method that we have decided to use. Now, let me just say that what you're going to see as I walk through these examples, what you're going to see is this spreadsheet doing a lot of independent calculation, and I had to go through and actually set up these calculations so that you could see the way that it works with a normal software being employed. Now, of course, a regular spreadsheet has no software attached to it, but instead of trying to make all these calculations on the fly, which are quite time consuming, I went ahead and I made them in the background, and I have hidden those calculations or have asked them not to appear unless certain things happen. And that is unless we have sales or purchases, and then those particular things start to happen. So in this particular example, they have given us a number of different transactions, starting with the beginning inventory and then having the first sale, the first purchase, second sale, second purchase, and third sale. And they tell us then at the very end, the firm uses a perpetual inventory system, and there are 5,200 units of the item on hand at the end of the year. What is the total cost of the ending inventory according to FIFO and LIFO? Now, understand that what the authors always do in all of these accounting texts is they assume a period of inflation. In other words, the cost of the units are always going up. That wouldn't necessarily be the case, but it makes for some theoretical arguments that you can make when that's the case, and I'll try to share those with you as we go. It may not be in this lesson, but in other lessons. But anyway, so without further ado, let's begin with this particular lesson, and let's look at the FIFO costs of inventory first. And it tells us that the beginning inventory was $3,600 at $4 per unit, and that calculates to $14,400, and it doesn't matter in this case since they've used the same costs. It'll be the same for your LIFO side as well. And then it tells us that we have a first sale of 2,400 units. Now, I'll just share with you that I looked down through all of those and I noticed that the per unit sale price didn't change. And since it didn't change, I've gone ahead and I've put the sales down here so that I can work off of those as we work through the worksheet. In this particular case, the first sale was for 2,400 units. And so up here in our worksheet, you will see that we started out with 3,600 unit. The first sale has to come from the beginning inventory, and under FIFO it would anyway, because the first one's in would obviously be whatever was in our beginning inventory, and then we would start with the first purchase after we had exhausted those. In this case, we sold 2,400 units and we had 3,600 units on hand, so we used in this case 2/3 of the beginning inventory, leaving us with an inventory balance after the sale of 1,200 units and a FIFO extended cost of 4,800, which is simply 1,200 units times $4 in cost. Now, I don't have that cost down here because as we go through it would change, and we could actually calculate it if we wanted to, but by doing that, you wind up really with more of a weighted average kind of a situation, and I'll do that in that particular lecture, but not in this one. The next thing they tell us is that we have a purchase of 8,000 units. So 8,000 units at $4.20 gives us $33,600, and under the perpetual method of inventory valuation, after every transaction, whether that be a purchase or a sale, we're automatically going to recalculate the inventory. And as you can see, I have a formula up here that does exactly that. Now, again, I didn't want a whole bunch of stuff down in through here to distract you. So if there wasn't an entry here, I just told it to leave everything else blank. In this case, we do have an entry, and so we've calculated then the value of that purchase. And it's, again, in this case, it is a mixed value because you had 8,000 units coming from the first purchase at $4.20 and 1,200 coming at $4. So this is actually a mixed number. It isn't a number that you can go up here and pick out. It's going to be some combination of the two, based upon the weighted average, actually, in this case. Now, the second thing that happens to us is we have an additional sale, in this case 6,000 units. So I'm going to come down here again and I'm going to type in the 6,000 units. And when I put in the 6,000 units, now something has to happen. Well, in the case of remember, this is where we left off, because we had 9,200 units at $38,400, and now we have to calculate where these 6,000 units are coming from. Remember, this is FIFO, so the first ones in are also going to be the first ones out, and we had 1,200 units left over from the beginning inventory. So those are the first 1,200 that go out, and then I have to go to the first purchase, and notice that the first purchase was 8,000 units. And so I need 4,800 from that 8,000, because 6,000 minus 1,200 is 4,800. And going further, 8,000 minus 4,800 is 3,200. So now I've struck a new balance at the end of that particular sale for 3,200 units at a FIFO extended cost of $13,440. Now, our book tells us now that we have, in fact, a second purchase. The second purchase was for 7,500 units at $4.40. And again, behind the scenes, I have some of this stuff working to automatically populate these fields, which would also be the case if you had regular software doing it. but that regular software would of course be a much more elegant solution than what I've provided for you. In this case, it's just the simplest way of doing it, and I would say to you that the actual computation uh, in this particular instance is um, fairly straightforward, but would not be in the real world, because you'd have to actually go back and look through maybe a multitude of purchases before you could finally get to your correct response. Anyway, in this case, we bought 7,500 units at $4.40. The extended value is $33,000. Adding those two together, you get $46,440 of inventory balance after the second purchase and inventory units of 10,700. Now we have yet one more additional sale, and that additional sale was for 5,500 units. So I type in the 5,500 for sale number 3, and now you will see that for sale number 3, because we're in the first in, first out method, I'm looking at whatever was left from that original inventory balance from right here, and I have to actually make a calculation to be honest with you, that if you look at this calculation, it has to look to see whether or not I have enough in my inventory, which was 3,200, to cover this sale, and I do not. So it forces me into looking at the second purchase to get to my next number, for in this case 2,300 units, because I need 5,500 total, and I've only got 3,200 in inventory from up here, so I have to go to this next purchase in order to get my remaining 2,300 at $4.40. Now the 5,200 are the units that you're left with. That's your ending inventory balance, and I could type that in. I haven't done that. And you notice that this 5,200 units is exactly the number that we're looking for. So that kind of tells us whether or not we are correct in what we're doing. Okay, so that takes care of the FIFO method. You notice that we have an ending inventory balance here of 5,200 units at $22,880. And what you're going to see, of course, is when we come over here and do the LIFO method, you're going to see a different number pop up here, but not a different number pop up here. That is, if I've done it correctly. Okay, so since we don't have a purchase before we have a sale, we have no choice but to take the first sale of 2,400 units out of the beginning inventory, and you'll notice that across the board here, everything is exactly the same through the first sale. Now we have a purchase, and the purchase is the same on either side of 8,000 units, and at $4.20 a unit. So the new inventory balance is going to be 9,200 units right here, $38,400. And you notice that it's the same whether we're here or we're here. And again, that's because we haven't yet got into the meat of the LIFO product yet. So in sale number 2, remember with LIFO, the last ones in now are the first ones out. So we would look at the latest purchase, exhaust that latest purchase before going back to the previous purchase and the previous purchase and the beginning inventory and so forth, okay? So sale number 2 will come first out of the first purchase. Now we bought 8,000 units and we sold only 6,000 units. So when we did that, I only need to take the 6 from the 8,000. And even though you notice here, and this is where you're going to start to see the differences occur, we still have 3,200 units, just like we did over here. The difference, however, is that we've got $200 less in cost. And the reason for it is this 20 cents right here times these 6,000 units. Okay? And that's how we're going to actually get to that difference in money. All right. Next we have a second purchase, and the second purchase, our book tells us, is 7,500 units. Notice the facts can't change. I mean, we still have the same purchase and the same sale. So now if you look at the inventory balance after purchase number 2, and remember, under the perpetual inventory method, after every single transaction, be that a sale or a purchase, we must come up with our inventory balance. In this case, $10,700. But now you will notice that we have still a difference in terms of the inventory balance after purchase number 2 is completed. And again, that's going to be when you're starting now to mix all of these costs, and you're actually starting to do what we call LIFO layering at that point. And finally, because of the way that this thing has populated, you'll see that we have a sale number 3, which is 5,500 units, and I'm going back to the latest purchase, and the latest purchase here was 7,500 units. And since it's 7,500, since that number is greater than this number, then I'm going to take all of my units from the latest purchase. So thinking about it in another way, what is left in the ending inventory of these 5,200 units for the LIFO method? Well, you bought 7,500, you took out 5,500, so 2,000 of the units have to come from purchase 2 at 440, and 3,200 of the units would have been left over from all the way back to beginning inventory, essentially. So that's what we refer to as LIFO layering. And you'll notice here that when we are all said and done, we are looking at $22,000 even on the ending inventory balance. And I have a little cheat sheet in my book that says that B is equal to $22,000. So we know that we are supposed to end with 5,200 units, and we know that we're to end with $22,000. So we are pretty sure that everything that we have done here is correct, and it has to be, or we would not have been able to arrive at these numbers. Now, I know I went through this fairly quickly, but again, most of that's due to trying to keep the overhead down. If you want to go back and take a look at some of the calculations, the ones that you're really looking for are these inventory balances, because the inventory balances are really based upon what method we're using. So anytime I have an inventory balance, I'm going to have a calculation that may involve a little bit more complexity. And again, it's not my purpose to show you necessarily the complexity of this, but I think it's instructional to note that when you use perpetual inventory, the computer coding behind the actual calculations can get rather arduous rather quickly. And this is a very simplistic example. We're not looking back beyond a couple of sales and a couple of purchases. If we were doing this for a real inventory system, you would be looking back until you were able to exhaust the number in your sales volume. Now, So for instance, if you had purchases of $100, or excuse me, 100 units each, and you had 10 of them for $1,000, and then you sold 800 units at one time, then you'd have to be going back through 8 of those purchases. I made no attempt to try to do that in this group of calculations, knowing that I was only going to have to go back through a purchase or two. But just bear in mind that the complexity in the real world is significantly more than the complexity that you see here. Now, let's talk very quickly about what this means. This is your ending inventory. Okay? So, other things equal, the higher the ending inventory, the higher the profit, the gross profit. The lower the ending inventory, the lower the gross profit, and eventually net profit. So what does that mean? Well, it means that in a period of rising prices, that LIFO inventories are going to yield the lowest amount of inventory, therefore the greatest amount of cost of goods sold, and the lowest amount of net profit. Now this is critical, folks, so try to grasp this. Again, in a period of rising prices, LIFO will yield the lower inventory, the higher cost of goods sold, and the lower net profit. And if you think about this, the lower the tax burden. Under the FIFO method, it will yield a higher inventory and therefore a lower cost of goods sold and a higher profit and therefore a higher tax burden. And that's the reason that you can switch from LIFO to any other method without permission from the IRS. But if you are under a FIFO or weighted average or any other method going to LIFO, you must get permission first from the IRS, because what's going to happen is you're going to reduce your tax load, and the IRS doesn't want that to happen. So that concludes this lecture. I hope that everyone was able to follow along. See me if you have any questions at all. Thank you.